Welcome to Phillip Futures webinar. I'm Joyce Liu, Investment Analyst with Phillip Futures. This is the first of the series of monthly Gold Futures webinar where we will be discussing current market events and trading opportunities in the gold market. To kickstart this series, today we will spend some time to introduce and compare the different gold futures contracts available for trading. Disclaimer: this presentation is solely for education purposes only. It contains the opinion of the analyst but does not constitute investment advice. Here is the agenda for today. In order, we will be discussing why gold market dropped more than 10% in 2 days, discussing the near-term outlook for gold futures, and comparing gold futures contracts available for trade. Breaking news in this issue: spot gold prices dropped a stunning 15% in 2 consecutive trading sessions, Friday last week and yesterday. This is in line with the extremely bearish picture we have been painting since late February. The collapse began on April the 12th. Spot gold prices dropped more than 5% in 1 day from US dollar 1560 per troy ounce at market open to 1478 at market close, and a further 8.5% yesterday to finish at 1353. Meanwhile, COMEX Gold, most active June futures contract, dropped 3.8% from 1561 at market open to 1501 at market close, and a further 9.4% yesterday to end at 1361. This entire gold market collapse, in our opinion, is a trilogy that started earlier this year. In chronological order, increasing signs of economic recovery in the US sets the stage for gold fund outlook. Since the financial crisis of 2008, gold prices have been upbeat for a combination of reasons. Firstly, its status as a safe haven asset makes it desirable during crisis and recession, when investors are jittery about almost any other markets. Secondly, the negative real interest rates make higher yielding assets such as stocks and gold more attractive. Finally, the large amount of money pumped into the US economy by Federal Reserve remains in the banks and among the rich and more credit-worthy borrowers, instead of serving its intended purposes of encouraging spending and long-term investments. As the economy picks up, firstly, investors' confidence in the economy's outlook improves. There is less need for safe haven assets. So investors start looking for other good yielding financial assets for investment. Gold, a non-dividend yielding asset with prices that many say are inflated, becomes less desirable. At the same time, as the prospects improve and having cleaned up a large portion of their balance sheets, banks become more willing to lend out the large amount of money they have amassed through years of bond buying by the Fed. As unemployment drops, people are more willing to consume, especially in the low interest rate environment, and corporates start investing in long-term plans. Money that was once parked in safe haven gold markets start flowing out into spending and investing. As such, we have a bearish backdrop for the gold market, as seen by the long downward trend channel since October last year. But what triggered the sell-off is likely the leaked Cypriot plans to sell €400 million worth of gold for its central bank to raise funds for its crippled banking system. The gap in its banks that must be covered is rumored to be much bigger than expected. Although €400 million converts to only about 10 tons of gold at market prices at that time, the move sparked fear among investors that other debt-ridden Eurozone countries may similarly be coerced into selling off their gold reserves to fund their own bailout. Countries such as Portugal, Italy, Greece, and Spain have hordes of gold reserves compared to the mere 13.9 tons owned by Cyprus. This is a very plausible scenario because selling gold is a politically more viable option than accepting austerity measures that further drags their domestic economies and burdens their citizens. But what exacerbated the sell-off to become a colossal collapse of no return are the automatic stop losses that are triggered by brokers, banks, and trading houses, especially when prices dropped through key technical levels, which prompted further selling. In addition, gold futures trade on margin, and trigger margin calls when prices move in the opposite direction. This forced investors who are unable to put up margins in time to liquidate their long positions. So what we just been through is a quick view of the latest important event in the market. The most important question is, going forward, what is the outlook? To address this question, we will be studying the technical charts for spot gold market, which the futures across all exchanges are closely tied to. This is the daily price chart for spot gold. As mentioned just now, gold prices have been trading in a downward trend channel since late October last year. Prices showed increasing signs of weakness towards the end before breaking down impulsively. Unlike previous times, gold prices failed twice to close in on the upper channel after rebounding off the lower channel. Hence, the bearish breakout was within our expectations. At current price levels, there are no clear signs of gold prices bottoming, whether on the daily chart or hourly chart. Hence, we prefer to look out for key support levels to come. We put our immediate support level at 1310, breaking which the next level is likely to be found at 1260. However, with some optimism in the Asian markets today, 16th April, if gold prices jump when US markets open, we can look forward to some sideways or upward correction in the short term. A big picture outlook remains bearish for now. Finally, we will be comparing the gold futures contracts available for trade. The global benchmark contract for gold futures is the COMEX Gold contract, which comes in lots of 100 troy ounces and is denominated in US dollar per troy ounce. By far the most liquid gold futures contract, it is physically settled with gold bars of refined gold, assay not less than 0.995 fineness. It is to be cast either in 1 bar or in 3 1 kg bars, bearing a serial number and identifying stamp of a refiner approved and listed by the exchange. The smallest tick bears a value of 10 US cents per troy ounce. That is to say, the smallest movement in the value of one COMEX gold contract is 10 US dollars, since one contract represents 100 troy ounces of gold. The contract months available for trade at any one time include the delivery month, the next 2 months, any February, April, August, and October contract within the next 23 months, and any June and December contract within the next 72 months. For example, now in April 2013, the contracts available for trading will include the current delivery month, April 2013, and the next 2 trading months, May and June 2013. We will also be able to trade August, October, and December 2013 contracts, February, April, June, August, October, and December 2014 contracts, February, June and December 2015 contracts, and finally June and December 2016, 17, and 18 contracts. First delivery day is the first business day of delivery month. For example, for the May 2013 contract, the first delivery day will be 2nd May 2013. For retail investors and speculators who have no interest in taking physical delivery of the gold bars, we have to close our existing positions with an offsetting trade before the first delivery day, or risk being called for delivery. To avoid unnecessary risks, some retail brokerages help clients to close off their existing long or short positions in physically settled contracts before the first delivery day. The last trading day literally refers to the last day the futures contract can be traded. Trading hours for COMEX Gold is the longest among all other popular tradable contracts. Apart from the most popular 100 troy ounce contract, COMEX also lists a mini gold contract, which come in lots of 50 troy ounces, half the size of the full contract. This contract is cash settled for the difference between the price at which the investor entered the market and the final settlement price. Although the smaller size of the contract reduces the initial margin required to trade the contract, the minimum fluctuation per contract is larger, making it more susceptible to margin calls. Trading months exactly mirrors that of the global benchmark COMEX Gold contract, and prices are floated or tagged to the price of the corresponding full COMEX gold contract. Since this is a cash-settled contract, there is no first delivery day to worry about. An investor can trade freely till the last trading day, which is the third business day of the delivery month. For the current April 2013 contract, that will be 26th April. Closer to us, the Hong Kong Mercantile Exchange lists a 32 troy ounce dollar-denominated gold contract that is also physically delivered, but with a higher degree of purity. This smaller contract also has a minimum fluctuation of 10 US cents per troy ounce, so a one-tick movement changes the value of the contract by only $3.20. The smaller initial capital required and smaller per contract value change is certainly desirable for retail investors who do not wish to stomach large fluctuations in the nominal value of their assets. Although physical delivery can also be posted under this contract, the first delivery day falls after the last trading day. This means retail investors who do not wish to take delivery of the physical gold only need remember to get out of the market by the last trading day. The most traded non-restrictive gold futures listed in Asia is traded on the Tokyo Commodity Exchange. This Tocom gold contract comes in sizes of 1 kg or 1000 grams, denominated in Japanese yen per gram. Note that because the contract is denominated in Japanese yen, the investor has to bear the currency risks of Japanese yen. Like the Hong Kong contract, it is also physically settled with 1 kg bars of gold with 0.9999 fineness. Based purely on contract specification differences, the advantage of Tocom contract over the Hong Kong contract is its trading hours. Trading hours of Tocom gold contracts overlaps with trading hours of US stocks. US stocks sometimes display good correlation to US gold futures, which, being the benchmark for gold futures, in turn influences gold contracts on other exchanges. Hence, Tocom Gold should track the benchmark COMEX gold more closely. The last contract that we would like to introduce today is the 50 baht gold contract listed on the Thailand Futures Exchange. 1 gold baht is about 15.244 grams or 0.49 troy ounces. Hence, 50 baht gold translates to about 762.2 grams or 24.5 troy ounces. The contract is denominated in Thai baht, so the investor has to take on Thai baht currency risks. The minimum price movement per contract is about 500 Thai baht or about 17.5 US dollars. Final settlement price is calculated based on the London AM gold fixing. The key benefit of this TFX contract, apart from the simplicity accorded by its method of settlement, is the price limit that has been put in place by the exchange. There is an initial price limit of plus minus 10% from its previous day's settlement price. When this limit is breached, the exchange will halt trading of the contract for a certain period of time, as determined by the exchange, to allow investors to cool off. When trading is resumed again, the price limit is then expanded to plus minus 20% of the previous day's settlement price. This helps to prevent irrationally large volatility and limit losses in the day. However, in real life, a 10% per day movement almost never happens. Now let's do a comparison of the 5 contracts I have just introduced. The table shows a comparison of the prices and affordability of each contract. Assuming a common price of 1,400 US dollars per troy ounce, exchange rates of 1 Japanese yen equals 0.01 US dollar and 1 Thai baht equals to 0.035 US dollars. The initial margins are per exchange requirements, and actual initial margin required by a local broker may differ. CME has since raised the margin requirements for COMEX Gold by 19%, but for fair comparison across the contracts, we will use its unadjusted margins. From the table, we observe that although COMEX Gold is the world benchmark contract, it may not be the most suitable for small players because of its higher contract value and initial margin required. We would recommend an investor who wishes to allocate about $3,000 for trading gold futures to consider TOCOM or TFX gold contracts, and one with about $5,000 to $7,000 for trading gold futures to consider Hong Kong gold and COMEX mini gold contracts. Benchmark COMEX gold contracts are suitable for investors who are willing to allocate at least $8,000 to $9,000 for trading gold futures. For investors seeking large leverage, TOCOM gold contracts are the most highly leveraged, whereas Hong Kong and TFX gold contracts may appeal more to investors who do not wish to be highly leveraged. Apart from a comparison of the quantitative monetary differences between the contracts, we should also examine the qualitative and non-monetary similarities and differences between the 5 contracts. Out of the 5 contracts here, we have 3 that are physically settled and 2 that are cash settled. For contracts that are physically settled, we have to take note of the last trading day and the first delivery day, sometimes also known as first notice day. For cash settled contracts, there is no worry of being unable to meet the legal obligations for physical delivery if an investor neglects to close off his or position, because for a cash settled contract, even if the contract was not closed by the investor, it will be settled for the difference in price between the final settlement price and the price at which the investor entered the market. Judging from the average daily volume and open interests, the COMEX gold contract is indeed the most liquid and most sought after contract. But trading volume for TOCOM gold contracts is also sufficiently liquid for investors to enter and exit the market at ease. TFX gold contracts have reasonable liquidity for the market to move, but may have a relatively higher bid-ask spread. To sum it up, COMEX gold contract is the global benchmark for gold futures contracts because of its large pool of international players and high liquidity. However, for investors who mind the large value of COMEX gold contracts, there are also other widely traded gold contracts that can be considered, but the cost and benefit of each should be weighed individually. We have come to the end of the first of our series of monthly gold futures webinar. I am Joyce Liu, Investment Analyst with Phillip Futures. Please stay tuned for more market updates.